Welcome to the Tech Today podcast with your host, John Maeda. John Ford once said that if the horizon is at the top, the picture's interesting. If the horizon's at the bottom, it's interesting. If it's in the middle, it's boring as shit. And one thing is for sure, 2024 is going to be anything but boring. What do I think 2024 is going to look like? Well, I think it's going to play out a bit like I thought 2023 was going to play out. So 2023, if you go back to what I wrote at Tech Today, I fully expected to see company reports show that there was an economic slowdown. And I talked about the cloud players in particular, that I'd expect revenue growth to slow as the year progressed. And we saw those slower earnings reports across tech for the most part, despite all the hype around generative AI and so forth. Revenue growth slowed. We didn't get as much of a slowdown as I would have expected because back in March of 2023, the Fed backstopped the banks. And if you recall, during the time of the Silicon Valley Bank failure, given that failure, banks obviously pulled back on credit. And that would have given us the hard landing that I expected to see in 2023. So the Fed kicked that hard landing down the road when they backstopped the banks with the Bank Term Funding Program, which is set to expire on March 11 of 2024. I don't believe the Fed will allow the BTFP to expire. So I believe the Fed's going to work to prop up the economy and to not have that hard landing. However, given the tightening of 2023 between higher rates, shrinking the money supply, stretching the consumer, I believe that insofar as, let's say, the first half of 2024 is concerned, I would expect things to continue to slow, given the lag effects of monetary policy in 2023. So I fully expect companies to provide conservative guidance when they start to report Q4 results in the second half of January and the first half of February this year. It doesn't make sense for the companies to be aggressive in terms of their 2024 outlook. Rather, better to be conservative and hopefully, beat those numbers as you report the year. The first signpost to look for will be the Bank Term Funding Program in March 11th. Does the Fed renew that? Do they not renew that? That's a big decision they have. I believe they will renew that program and continue to prop up the banks. Insofar as interest rate cuts are concerned, the consensus seems to be that the Fed will cut in March. I fully expect the Fed to cut. The question is to what degree. If the economy really starts to roll over, the Fed will cut much more aggressively than they outlaid in their economic projections coming off of the most recent FOMC meeting. They'll go to zero or awfully close to zero in short order if the company really starts to roll over, if we see a spike in unemployment, if we see the banks struggle with their balance sheets, the Fed will step in quickly. And I believe it's the bank balance sheets is what spooked the Fed and is the reason why Powell was dovish in his comments off of the recent FOMC meeting. I think those net unrealized losses of $684 billion across the banking industry. I think Powell has insight to the banks that we don't have. Obviously, he can see information that's not publicly available in bank filings. If you look at Bank of America as an example, off of the last earnings report, the bank had $136 billion in unrealized losses, $107 billion of which were in mortgage securities at a yield of 2.12%. So who knows where the accounting was around the middle of December when the FOMC meeting occurred, and perhaps Powell got a glimpse of B of A's balance sheet, JP Morgan's, and decided, the Fed has pushed the banks enough, we have to ease up a little bit. And therefore, he was very dovish with his comments and effectively got yields down. And you would expect that when the banks begin to report, B of A, for example, reports on June 12th, that those unrealized losses, I don't know if they'll be a bit less than September 30 when they last reported, but I would expect that those unrealized losses today are less than what level they were at in the middle of December, given that yields have come down. Yields have come down, bond prices, therefore inversely related, have gone up. The Fed has effectively started to reinflate the bond market, which will provide some air cover to the banks insofar as their balance sheets are concerned. In addition to the Fed, we have fiscal policy. That too is an unknown. I expect the Biden administration to try to push through a stimulus program similar to what we had in 2020, 2021, whereby checks were mailed out to Americans. I expect the Biden program to try to do that again. I think general consensus is that if the Biden administration tries to push through that type of a stimulus program, that the GOP-led House will push back and kill that program, that stimulus. I don't believe that's necessarily the case. I believe there are a lot of Republicans in Congress that want money to spend, that want money to send home to their constituents. They could point the finger at the Democrats and get the money and have the best of both worlds, rather than have the difficult conversation with constituents, explaining to them that stimulus checks, i.e. government handouts, only exacerbate inflation, and that it's never a good idea for the government to prop up the economy. I'm not so sure that the Republicans will stand in the way, and I could see a stimulus program going through. I would expect that to happen somewhere in the bottom of the year, probably around the 4th of July holiday. That way the effects and the good feelings that many may have as a result of receiving a check in the mail will be close enough to the November general election. So fiscal is going to play a big part this year. I think fiscal spending year to date, the first 2 months of fiscal 2024 as compared to the first 2 months of fiscal 2023, fiscal spending is up 17% year to date. So managing the government the way the executive branch and Congress are doing at the moment, which is by continuing resolution as opposed to a full budget, that's a very expensive way to operate the government. Yellen has built the Treasury's general account back up to around $1 trillion. So that could be another way that the Biden administration could stimulate the economy. If an explicit stimulus package gets held up in Congress, Treasury could kind of keep things rolling without a budget, so long as there's a continuing resolution in place and so long as the TGA is full. So Treasury can stimulate the economy as it did throughout I guess it was the second half of 2021, 2022, right through June of 2023. So fiscal is going to play a big part. The central planners are going to play the lead role in the U.S. economy for 2024. Right? That's been the case. I mean, you could argue that's been the case since the Fed and Treasury bailed out the banks in 2008 and 2009. That's certainly been the case since the COVID response of 2020. The capital markets are no longer free and private markets. They are government-led markets, central planner-led markets. And frankly, the fundamentals have not mattered, or they have mattered very little since 2020. The capital markets, both on the debt side and the equity side, have been largely driven by the central planners' actions and investor sentiment around those actions. Earnings matter a whole lot less. Revenue matters a whole lot less. Who manages these companies matters a whole lot less than it used to, at least insofar as the short term is concerned. Short-term, intermediate term. But we are in a centrally planned economy. And frankly, it's not a fun one. And it's not a healthy one for the U.S. economy. So given a spend-happy fiscal side of the ledger, given a dovish Fed, which means an easing monetary side of the ledger, there's going to be upward pressure on assets in 2024, whether we're talking about fixed income assets, equity assets, classic cars, art, houses. However, there will also be downward pressure given the Fed's actions on the monetary side in 2022 and 2023 in terms of lifting its Fed funds rate and quantitative tightening. So those two actions, those two policy tools, Fed funds and QT, have very real effects. Those effects are lagging, and they will put downward pressure on asset classes. So I think initially, we're going to see a net negative impact to the economy and to asset prices in the first part of 2024 as the Fed eases, as the fiscal side starts to spend. Will that be enough to lift the economy? It's unclear. Will it be enough to sort of lift asset prices in the back half of the year? It should be. But this year has been the murkiest year as you look to the horizon as any time in my life that I can remember. That's all for now. See you next time.